All right, let's dive right into this explainer. If you're gunning for that A-star on the IGCSE Accounting 0452 exam, you already know the deal. Concepts like the depreciation revaluation method, they aren't just basic record-keeping exercises, they're the absolute bridge between simple data entry and high-level financial intelligence. So today, we're taking some incredibly dense accounting source material and breaking it down into a highly structured roadmap to get you exactly where you need to be.
To conquer the 0452 exam, we've got a solid blueprint. We'll be covering 4 main sections: core concepts and terminology, mastering technical execution, interpretation and ratio analysis, and finally, advanced exam strategies. Let's get to it.
Section 1. Core concepts and terminology. This is all about building that foundation.
Now, here is something you literally cannot ignore for the 2026 syllabus. Cambridge is getting incredibly strict about terminology. Those old habits, yeah, they're going to cost you easy marks. You absolutely must drop the outdated terms. So instead of bad debts, you've got to say irrecoverable debts. And it is owner's equity with absolute 100% accuracy. The examiners are specifically hunting for this level of precision to prove you actually understand global accounting standards.
And while you're locking down that vocabulary, you've also got to internalize the duality of, well, every single transaction. It's the golden rule, right? Assets equal liabilities plus equity. This equation has to stay perfectly balanced at all times. Think about it like a giant scale. When you adjust for depreciation, your asset value drops, which means your equity simultaneously takes a hit as an expense. Keeping that perfectly balanced is the whole heartbeat of the business entity concept.
You also have to master the prudence concept. Honestly, think of this as a massive glowing warning sign telling you never to violate the rules by overstating your profits. When you're dealing with the historical cost principle and revaluation, it's super easy to accidentally make things look better than they are by ignoring potential losses. But the prudence concept demands you recognize those losses immediately. Basically, never make the business's financial reality look artificially inflated. To really navigate these tricky, multi-layered scenarios, you've got to master a few more key terms. Consistency is huge, meaning you use the exact same depreciation method year after year. Then there's realization. You only record profits when they are legally, actually earned, period. And you definitely need to lock down accrued and prepaid. Why? Because the whole system's transparency depends on it. Interested parties like banks and tax authorities literally base massive financial decisions on the integrity of your records.
Moving right along to Section 2, Mastering Technical Execution. This is our structural framework. Okay, so what does the actual execution of your ledgers look like in practice? It's a specific methodological flow, and it always starts with identifying the correct business document. Think invoices, credit notes, or bank statements. It's basically the DNA of your transaction. That DNA acts as the source for your books of prime entry. From there, you move right into the T-account double entry system, and it all culminates in the trial balance. Sticking to this exact order is how you minimize those brutal calculation errors and transition seamlessly into the financial statements. Now, if you're the kind of person who sweats bullets over making a tiny math mistake during an exam, take a deep breath. Seriously, let this be a massive relief. Cambridge awards what they call method marks. This means you must always show your workings for things like depreciation adjustments, inventory valuation, or error corrections. The examiners actually reward your logical flow even if your final math is a bit wonky. If they can clearly see your process, you get marks. But catch is, if you hide your workings, you get absolutely nothing.
But ideally, we still want to get the math right. So watch out for these really common mathematical traps. A big one is messing up the percentages when you're dealing with trade discounts versus cash discounts. They are not the same. Also, in your T-account structure, you absolutely must master the art of balancing. Do not mix up your brought-down balances, your balance BD, with your carry-down balance CD. Oh, and a quick bonus tip straight from the source material. Never, ever forget the vital importance of state symbols in your manufacturing accounts.
All right, Section 3, Interpretation and Ratio Analysis. Time to evaluate the property. This is where we hit Assessment Objective 3, or AO3. Look, just calculating a ratio is baseline stuff. Interpreting what it actually means, that is what secures your A-star. Imagine you're looking at a business and their current ratio just violently tanks from 2.5 to 1 all the way down to 1.1 to 1. Sure, you calculated it perfectly, but what is that actually telling you? This is where you put on your detective hat. You have to ask yourself, why did liquidity drop so incredibly fast? And what does this specifically mean for the business? A drop like this is a massive, blaring alarm bell. But just writing liquidity is lower on your exam isn't going to cut it for AO3 marks. You have to explain exactly why it happened, using the analytical tools you have.
A true A-star response is going to explicitly analyze the root causes. Did the business just overpurchase a ton of inventory and tie up all its cash? Are they settling trade payables way too slowly? Or, and this is a critical one, were their cash reserves totally wiped out by heavy capital expenditure? Like maybe they bought shiny new machinery that now has to be depreciated over the coming years. Identifying these specific scenarios is exactly how you prove high-level financial intelligence.
And while you're doing all this evaluating, keep in mind that direct comparisons between different firms are incredibly tricky. Think about it. Different businesses use completely different accounting policies. One shop might use the straight-line method of depreciation, while their biggest competitor uses the reducing balance method. Comparing them at face value is actually super dangerous. You have to understand that these differing policies distort direct comparisons, and you absolutely must note this in your evaluations.
Okay, home stretch, Section 4, Advanced Exam Strategies, the final certification.
Let's pull some direct intelligence straight from recent principal examiner reports to finalize your attack plan. This is the tactical advice that bridges the gap between knowing the facts and actually scoring the points. And honestly, it sounds almost silly, but poor handwriting is a massive warning flag that consistently costs students extremely easy marks in their T accounts. Remember those method marks we just talked about? Well, if an examiner literally cannot confidently read your numbers or your labels, they cannot award you the points. Legibility in your ledger accounts is an absolute must.
Another major spot where people bleed marks is failing to distinguish between revenue and capital items. You absolutely must use a mental checklist to separate these two categories perfectly. Because if you misclassify a capital expenditure as a revenue expense, boom, it completely ruins your profit calculations and throws off your entire depreciation baseline. So keep that straight. And while you're at it, carefully manage your time based on the weightage of each question part. Please, don't spend 20 minutes sweating over a simple 2-mark classification question.
Finally, to really lock in that top grade, you have to look past the surface numbers. You need to analyze the true quality of the profit, and that involves considering crucial non-financial factors that impact metrics like the return on capital employed, or ROCE. We're talking about staff morale, the physical location of the business, and overall market reputation. None of these things live in the accounting ledgers, but they are absolutely vital for the business's long-term sustainability.
So, as we wrap up, I want to leave you with a critical thought to chew on. You can have the most pristine ledgers, perfect terminology, and absolutely flawless depreciation calculations. But ask yourself, how do the unrecorded, deeply human elements, like the morale of your staff or your reputation in the community, ultimately dictate the true financial reality of a business beyond what any ledger can show? Keep that perspective in mind. Apply this blueprint meticulously, and you are going to absolutely crush the 0452 exam.